This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. We're about 6 weeks away, 2 months, 6 weeks away from the Planet MicroCap Showcase Vegas in partnership with MicroCapClub, which will be held on April 22 through 24, 2025 at the Paris Hotel and Casino in Las Vegas. Join 400 plus investors and approximately 100 companies already registered for the event at what will be the Super Bowl of microcap investor conferences. We also announced our keynote speakers. We got Adam Epstein, Cromwell Coulson, Ryan Telford, Andrew Walker, Artem Fokin, plus stock pitches from some of the best microcap investors, and we'll be hosting our live podcast panel. You never know who might show up. And go check out the list of presenters slated to showcase their businesses as well. If you love microcaps, you can follow, listen here casually. You don't want to miss this. Registration is now live. Please visit planetmicrocapshowcase.com, and I'll see you in Vegas. Now, my guest on the show today is John Rotonti, portfolio manager at Islamorada Investment Management. John very recently joined Islamorada Investment Management, running their industrial and infrastructure portfolio, and he's been actively researching and dissecting everything about the electrification of everything, plus anything housing related. We jump in headfirst on his investing philosophy and checklist criteria when looking at this swath of companies. And for full disclosure, we discussed a number of companies during today's podcast, and I'm not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with John Rotonti. John, thank you for joining me today. How you doing, man?
I'm doing well, Robert, and I'm glad to be on your show. Thank you for having me.
Absolutely. It's great to have you. You know, I've been a follower from afar for a while now. And, look, I know you don't specifically kind of look in our space a little bit, but you know what? We don't care. We just love to talk ideas and strategy, philosophy, and getting after it. But, before we hit record, I didn't realize you were based in New Orleans. We're recording this on Wednesday, February 12th. How you holding up, man? It's been a crazy week.
It was a crazy week. I tell you, Philadelphia fans came in strong. Just based on jerseys and green attire, I think it must have been 70% of the fans that came in town were Philly fans. Night
they travel well.
They travel well. Yeah. A lot of celebrities came in town, and I'm not normally starstruck. I'm much more struck by like investing, celebrities. But on Friday night, one restaurant in town, great restaurant, right on Magazine Street. One table was Taylor Swift, Travis Kelce, and Patrick and Brittany Mahomes. At that restaurant that night, Jennifer Coolidge was there. Joe Montana was there.
Yeah.
Paul McCartney was eating at a restaurant in town. Martha Stewart, Kevin Costner went to the game. Miles Teller. It was nuts, man. It was nuts.
That's pretty crazy. Did you go to the game itself, or did you stay at home?
I didn't go to the game, but I live close to a busy street where a lot of tourists like to hang out, eat, dine, go to bars. So I feel like I witnessed and felt a lot of it, but I wasn't actually at the game.
For sure. No, I mean, it is, look, it's a Super Bowl for a reason, right? It's so much fun. And I was joking offline when we were watching the game, and everyone's like booing, they were booing Taylor Swift, and like with my wife and sister-in-law, and I'm like, why are they booing her so hard? I'm like, dude, you just confirmed what I thought. It was probably majority Philly fans. They travel like nut jobs, and you know what? She's cheering for the Chiefs. Do you think they care? They had a great time at the Eras concert. Like, no, she's cheering for the enemy right now. They're gonna let her have it.
That is true. I don't think it was personal. The Philly fan just packed the dome. They packed the Superdome, and so she was a little outnumbered on that night.
Yeah, listen, as a New York sports fan, as much as I truly hate all Philly sports teams, it's hard not to respect the freaking passion, and you gotta love it. It's always fun when like you're able to watch a game where it's New York Philly or something, and you're with a real true blue Philly fan, and I always enjoy the banter back and forth. So it's I'm glad New Orleans ultimately ended up in one piece post event though.
We made it, and if you hear people like Miles Teller or Bradley Cooper, lifelong Philly fans, speak about the team, you kind of feel their passion too. So it was a good week for the city of New Orleans.
Very good. All right. Well, John, like I said, been a follower from afar on the socials. I know you started this pod, I think, and within the last year, we've had some unbelievable investors on there too. So again, this is a long time coming, and we wanted to save this one until you got the new gig where you're at now, where you're now at Islamorada Investment Management as a portfolio manager, managing their industrials and infrastructure portfolio. So we're going to dig into all of that. But first, for those that don't know you, your background, where did your passion for investing begin? And then ultimately, how'd you land over at Islamorada?
Yeah, thanks, Robert. So my passion for investing began as a freshman in college. When I got to college, I didn't know the first thing about investing. I did not know what a stock was, not a bond. I really didn't even know the value of a dollar because I grew up in a really comfortable household. My parents sheltered me and my two sisters. They were paying for my private education, university education. But when I was a freshman, I learned that my parents got into some financial trouble. And it's the first time I knew about this because, like I said, they sheltered us and they weren't fully truthful about everything that was going on with the family finances. And so I'm away from home for the first time, and I'm feeling kind of guilty because they're paying for my tuition. And so I realized I need to do something to try to help. And so I was like, let's learn how to invest. Like crazy. I didn't even know what investing was. And so I went to the library and I started reading books on investing. And I eventually read Peter Lynch, One Up on Wall Street. That book changed my life. Several books since then have had just as much influence on me. But that book was the first one when a light bulb went off in my head, freshman in college. And I realized two things. I realized I understand the things that he's talking about, which was one thing, because that was a big epiphany for me because I didn't know what investing was a week before. I didn't know what a stock was a week before. So the first epiphany was I understand this. And the second light bulb and epiphany was I love this. I'm hooked. And I think this is what I want to do for the rest of my life. Freshman in college, 18 or 19 years old, and I'm 44 now, and I haven't stopped reading about, thinking about, studying about, talking about businesses, markets, and investing.
That is so cool. One Up on Wall Street was my first book too. I think I said on a pod, maybe it was the most recent one I did, where I need to do a good reread of it. Especially now. That was my first book I read as well, and that was when I was a junior in junior in college. And now with the full experience they have now, is just reading it with the kind of different lens. I've been wanting to pick it back up for sure. Okay. Oh, sorry.
It's a good one. When people sometimes, actually quite often, ask me what books they should start with, I always recommend that one, and then The Little Book That Beats the Market by Joel Greenblatt, because that book you could read in an hour, and it's two metrics in the whole book. It's two metrics and two concepts. Each metric represents a concept. The first metric, as you probably know, is return on invested capital, and that represents the concept of investing in high-quality businesses. And the other metric is the earnings yield, and that represents the concept of trying to buy these high-quality businesses at discounted valuations. So the whole book is two metrics, two concepts, and so I think it's a really good book to start with.
100%. So then, all right. So that's where your passion. You realize, okay, this is what I want to do for the rest of my life. You also had a experience at the Motley Fool as well, too, right? Before going to Islamorada, can you tell us a little about that? How you landed there? Want to hear the whole genesis? From all right, passion. I'm there. Not on a year by year basis, but kind of the main benchmarks of okay, I went here. This is what I learned, and then ultimately at Islamorada.
Absolutely. So graduated college and. I'm going to mention this just because it has helped me get to where I am today. It has opened doors for me. I studied really hard in college, graduated Phi Beta Kappa and magna cum laude. I mention that because people also ask me, how'd you get these jobs? How'd you build this network? And, having that on my resume helped. It got me a call back. It got me an email back. It opened a lot of doors. And so I studied hard in college, went back home to New Orleans, and briefly for a couple years worked in the family business, which was hospitality in New Orleans. We owned a restaurant in the French Quarter and a small boutique hotel in the French Quarter, 14 rooms, really small, like a guest house. And, that was okay. But this whole time that I'm working in hospitality, in the family business, all I can think about is stock investing. Because remember, I got that bug a few years earlier in college. And so I told my parents I don't want to do the family business. I went back to get an MBA at Tulane. Once again, just mentioning it because I think it helps some people understand what it takes. Graduated in the top of the class, top cohort. It's called Beta Gamma Sigma. And it's a two-year program. I graduated in a year and a half, so took a lot of hours, packed it in, went right to New York, worked as a institutional equity sales at a small cap equity research firm. Fantastic first job out of MBA school because one, that's when I started to build my network. My job was to cold call basically mutual funds and hedge funds all day long and build relationships with them. So that's when I started to build my network, which is, I think, by far my most valuable asset that I have. I've been building it since now 2010 is when I first went to New York. And the other thing is, as we covered 500 small caps at this equity research firm, I was on the sales side, but I would have to be able to talk intelligently with my clients about 500 stocks. It's almost insane to think about. Equity research analysts on the sell side have all the respect in the world for them, but they're covering their 15 to 30 names, whatever, 12 to 30 names, whatever it is, in their vertical, and they become experts on those businesses in their vertical. But on the sales side, we had to be able to speak somewhat intelligently about any company under coverage, because we could get a call from one of our clients. Hey, what do you think about the most recent earnings? Whatever. And so I learned how to build processes to cover a wide range of companies in that sales job. But I sucked at sales. Could not make a living doing sales long term. And it's because, we were paid mainly in soft dollar. Our clients would trade across our desk in trading commissions. And so, I would only make money if I got my clients to trade. But I would call them and spend 45 minutes talking about, so-and-so company's moat, never mention whether I think the company's attractively priced or not. Or if I did mention it, I didn't sell it well because they never really bought stocks across our desk from what I said. And so I just wasn't good at the sales side of equities. I was great at building these relationships, having long conversations with them about these companies and their business prospects and their moats over the long term, but not good at getting them to trade in and out of these stocks because I had a long-term focus. And, to make money as a trading firm in that way, you need to get them to trade a little bit more than a long-term focus. I eventually wrote a book on investing, published that in 2013, wrote it in 2012, published it in 2013. It's just a very, very introductory level book on investing in common stocks. Very, very introductory level. And then started the Motley Fool in 2014. I was there almost 9 years. When I left, I was a senior analyst. I was a portfolio lead, and I was the head of investor training and development. And the last thing I'll say is that as the head of training and development, I helped train all of our new analysts, put them through a pretty intensive 6-month training program. The second responsibility was I served as a resource to the whole investing team, not just junior analysts, everyone all the way up to the chief operating officer of the investing team and the chief investment officer. So if someone needed help, thinking through a thesis, building a model, finding a piece of research, coming up with a list of questions for management, just bouncing ideas off of somebody, whatever it is, I was there to be that resource resource. And the third thing was I was responsible for networking on behalf of the investing team, bringing in outside experts, academics like Demateron and Mobison, but primarily practitioners, portfolio managers, to give guest lectures to our investing team internally, almost like a continuing education program. When I left the Motley Fool, I launched the J-Ro Show podcast that interviewed portfolio managers that I admired. Many of these portfolio managers I consider to be among the best in the world. And I wasn't asking them about stock picks. I don't think in the 15 or so interviews that I did, I asked them about one stock pick. The questions were all about what's your investing process, what's your philosophy, and what's it like to be an analyst or portfolio manager at these firms day in and day out. Like literally, how is the day spent? If an analyst has to make a deliverable, what does that deliverable look like? How many pages is it? Is there a model attached? Is there a PowerPoint? How often do you travel to conferences? How often do you speak with management teams? What do your models look like? How many years out are you modeling? Deep into the process of what it's like to be an analyst or portfolio manager. Through that podcast, thank goodness, Cale Smith, the founder, CEO, chief investment officer at Islamorada Investment Management, found me, and we started talking. And over 6 or 7 months, we built a relationship. We learned to trust and respect each other as people and as investors. And he finally offered me a dream job. And so that's how I'm now a portfolio manager.
Heck yeah, dude. Oh, that's an awesome genesis. Thank you for sharing your entire background there. So, we're going to do something similar here today, right? That you're doing the J-Ro Show, but you're going to be in the spotlight here, and wanting to talk about, your philosophy and your strategy. And, I'm also curious before we even get into that, how did you land as your focus being industrials and infrastructure? What about these two sectors interested you the most? Was this something that Islamorada, just curious how that came to be?
Absolutely. So, I picked it.
Okay.
So Cale gave me a lot of leeway in crafting the portfolio philosophy and strategy that I thought would be best for our clients over the long term. Industrials and infrastructure is just the name of the strategy. It's also housing related businesses. First thing I'll say. The second thing I'll say is infrastructure and industrials is extremely broad, at least the way that I'm defining it in my strategy. So the G20 Global Infrastructure Hub put out a report estimating the world will need 100 trillion in global infrastructure investment through 2040. It's actually 97 trillion, but let's round up for fun to $100 trillion.
Extra trillion. Yeah.
Yeah. So at a high level, based on a lot of research and reading I've done, not just that stat. This is a long duration, secular demand driver. I believe this is a long duration, secular demand driver that is still underappreciated by the market. Infrastructure is everything from AI is getting all the attention right now in the media and on social and on some of the financial news stations, but AI, and we can talk about some numbers later on if you want. AI is a today at least a relatively small subset of global infrastructure spend. But if you think about just AI, if you think about just a data center, that's everything from the GPUs and the server racks to the cooling equipment to the copper and fiber optic cabling to the sensors to the connectors, tiny electrical components that you need, to the networking gear, HVA systems. I said liquid cooling, the actual construction engineering firms building these data centers, the electrical and power companies powering these data centers. It's almost endless, and that's just AI, and that's just a small component of overall infrastructure spend. Beyond that, we have a bunch of multi-industrials in the portfolio, which are really industrial technology companies that serve anywhere from 5 to 8 different verticals, AI and digital just being one of them. And then housing related, that's everything from home builders to building supply companies, building material companies, to companies actually doing some third-party installation of these supplies on behalf of the builders, to home service companies, everything from pest control to plumbing to lawn care, decking companies. The list goes on and on. So it's a very diverse pool of what I consider to be very high quality, long duration, profitable growth businesses, and run by some of the best management teams I've come across in over 20 years of doing this. And as far as why give it any theme at all, why not just call it the quality portfolio or something like that? It's because the long-term goal that we have, and this is not an immediate goal, but a long-term goal, is to eventually turn this into an ETF. And we think that it may be a little easier to market an ETF if it's got some classification identifier to it.
Makes total sense. I mean, even outside of that being your long-term goal, it also doesn't hurt to have a focus. I mean, still within those two themes, the investable universe is massive, right?
I think so.
Absolutely massive. So, I mean, let's drill into that. You basically kind of alluded already to your philosophy here. What are some of your criteria when we got industrials, infrastructure, housing related type companies. Now we got to drill down into what our criteria or ideal investment looks like. Can you go through some of what your checklist items are?
Absolutely. So the only requirement that I have is that it's domestic only. Outside of that, I think the most important thing is every business that I invest in, I have to believe, based on my analysis, that it's extremely high quality. And I think of high quality as business quality and managerial quality, with a strong emphasis on management. So a CEO and his or her leadership team that think and act like owners and that are economically aligned and incentivized to run the business in a way that benefits outside shareholders over the long term. I mentioned, business quality. The vast majority of holdings will have already achieved scale. Not necessarily microcaps, although I do have a few $2 billion market cap companies, a few $5 billion market cap companies, 7 billion, 8 billion. So I don't go micro, but there are some smaller companies, at least relative to what I've looked at. But most of them have already achieved scale. They have healthy balance sheets, sometimes with net cash. They have high or rising returns on invested capital. They have stable or growing free cash flows. And what I believe to be high terminal values with long runways of per share growth. Importantly, and I try to stress this as much as I can, the rate of growth right now, how fast the company is growing, how fast the company is expected to grow in the next 1, 2, or 3 years is much less important to me than the durability of that runway of growth, the sustainability of the per share growth. I believe that if you look at the math of compounding and the math of investing, moderate growth, per share growth, extended over the longest period of time is when compounding is most powerful. And so as long as the valuation is appropriate relative to the growth rate, the rate of growth is less important to me than the duration of per share growth. Those are some of the metrics I look at. Beyond that, I have to believe they have high barriers to entry, wide and sustainable moats. Several, Robert, of these companies operate in oligopolies or duopolies, in some cases maybe even an earned monopoly, with high and stable market shares. When you get into this oligopoly space, you don't see a lot of share shifts, right? It's like 3 companies, each have a third. They're each happy with their third. They're not going to, try to mess up the system. So high and stable market share, pricing power, and limited competition. Other companies have leading market share, but the market share may be low. It may be 5%, 7%, 11%, leading market share of a highly fragmented industry. And I believe that they excel at, M&A, at acquiring other businesses, consolidating this industry. And so in that case, they can grow in two ways. They grow through organic market share gains, but also through this basically roll-up process. Roll-up has a negative connotations. A lot of times they don't work, but when you can find one that does work, and the industry remains highly fragmented, in those cases, when the management teams do really excel at capital allocation and making these acquisitions, and they've built a sort of platform company, a machine to make these acquisitions, in those cases, it's not entirely clear to me why they can't continue to grow at mid-teens rates for as long as the management teams remain in place. I mean, that's at least a reasonable scenario, in my opinion, that some of these companies can grow at mid-teens rates, not for 5 or 10 years, but for decades plus. Based on my analysis, that's what I believe, as long as these management teams are in place, because they've built this sort of acquisition platform.
Mm-hmm.
Yeah, I mean, just emphasis on business quality, emphasis on those metrics, emphasis on the management team, not only capital allocation, but also how they operate the business. And the last thing I'll say is businesses that have shown me, management teams that have shown me that they are resilient and adaptable, that they have survivorship genes, that they've survived, multiple crises, multiple cycles, and come out stronger on the other end. Really, these survivorship genes, the adaptability, the resilience, and then almost a maniacal focus on long-term intrinsic value per share growth.
Beautiful. No, that is a very detailed, nice checklist. And what's really cool about it, but I am going to ask a follow up on it. What's really great about it is that, whether you're focused on, just infrastructure, industrials, housing, I mean, everything you said there, I think people who are probably listening are like, oh, I use that even outside of, those specific focus, those areas of focus, but is there anything on your checklist or that you also look for that are, let's say, are specific to, infrastructure deals that you might be looking at, or in the housing or whatnot? I mean, you kind of alluded to in fragmented, some oligopoly, duopoly, whatnot, but that can still carry over to some other industries too. So specific to infrastructure, housing, or industrials, is there anything else that you kind of look for as you're drilling down into some of these individual names?
Absolutely. So the first thing I'll say is just in general, there's certain industries and sectors that have industry specific metrics that are important to understand and important to follow. Insurance, it may be the combined ratio, expense ratio and loss ratio, the combined ratio. In banking, it may be, net interest margin, net interest income growth, loan growth, asset growth, return on assets, leverage, so that you can get the, banks earn 1% on assets, 1.5. How much leverage do they need to increase that to a return on equity of 10, 12, 13%? So different industries have different industry specific metrics. It's the same here, with home builders, it may be starts, home starts, and with some of the industrials and infrastructure plays, it may be backlog and the growth rate of that backlog and the margin on the out years backlog. I've got a company, it's just very case specific is what I'm trying to say. I've got a company, a global infrastructure company in the portfolio that, if you look at it, if you're running a screen for, PE ratios less than 30 on 1 year out numbers, it doesn't screen because the PE is 40 or 50, but it's misleading based on my analysis because this company has over $100 billion of backlog, $100 billion. And it's not going to start to hit, because some of these projects, these mega projects, Robert, they take years even to just break ground. So they announce the project, they don't put a shovel in the ground for 2 or 3 years later. That's how long cycle some of these projects are. And then, building the actual project, the actual construction could take another 5 to 7 years. You're looking at a 10-year project, but sometimes the permitting process alone is 2 or 3 years. So this backlog doesn't even begin to start to hit until 2026. And then it accelerates from there. And the backlog's margins on the out years are higher margin than the front-loaded years, because its customers are desperately and urgently trying to buy slots for some of this industrial equipment 5 and 7 years out. That's how short of supply some of this industrial equipment is. And when they're urgently fighting for these equipment slots 5 and 7 years out, well, that gives you pricing power. I mean, they're fighting over these slots. And so the out year backlog has much higher margins than the near term backlog. And even if it didn't have higher margins, which it does, the backlog doesn't even start hitting revenue until 2026, but really 2027 and 2028. And so when you normalize for this higher margin backlog, the stock's trading at a very low PE based on my analysis. So it all depends on the industry. But backlog is important with industrials, infrastructure. Book to bill is important. So with housing, I talked about some starts and some other metrics like that.
Let's dig in a little bit to maybe some of the industries within. Let's talk infrastructure specifically. One podcast we help produce here, Yet Another Value podcast. Andrew Walker did a great interview with Jeremy, and I apologize if I mess up his name, Ontiveros, talking about AI and data center infrastructure. That clearly is kind of taking the market by storm, and most folks are kind of being pretty active in there. Are there any other sub industries within infrastructure that's been catching your eye that maybe the market is missing, and you think there might be some risk adjusted alpha in there?
Well, my portfolio is, I would argue, very well exposed or adequately exposed to AI and the data center build out, but it's not the theme I'm most excited about, or that I have highest conviction in. The theme that I have highest conviction in is this global infrastructure build out of $100 trillion, and then through 2040, and then under that, the theme that I'm most excited about, and it's probably the topic that I've posted about most on X over the last 4 years, is the electrification of everything. And that's phrasing that I've used. You could go to X and do a search for JRoGrow, electrification of everything. There's probably 24 tweets that have come up. That's really the theme that have highest conviction in. So, the electrical grid in the U.S., let's just look at U.S. right now, is 50 to 70 years old. The electrical grid needs to be invested in for lots of reasons, but 3 main reasons are: some parts need to be replaced entirely. That's number one, because it's 50 to 70 years old. So there's a lot of replacement, or at least repair. That's number one. Number two is the grid doesn't only need to be replaced and repaired and updated, it needs to be made more resilient. This is a second subcategory to natural disasters or severe weather events, whatever you want to call it. Hurricanes, wildfires, tornadoes. It seems as though, they are, for whatever reason you want to attach to it. I'm not going to attach a reason. I don't know the reason, but they are increasing in severity and intensity in recent years. That may not continue, because everything is cyclical, I believe, over long periods of time, but they're increasing in severity and and incidents. And so number one is they need to repair and replace the grid. Number two is they need to make the grid more resilient to these extreme weather events. And then number three is they need to literally increase the amount of electricity and transmission distribution because we are electrifying everything. AI is one example. Data centers are one example of the electrification of everything. But then you have electric vehicles, which is just massive. You have electrification of the home. You have the electrification of appliances. You got billboards that are electrical now. I mean, it's just on and on and on. Really, this electrification of everything. So when you
not to stop you real quick and cut in, but because I want to continue on this, just to add in a silly joke, and I apologize for interrupting you, but
no, please.
I remember what was it? I think starting 5 years ago. Literally, I think I can't remember how many companies I interviewed, but you started seeing the theme of Internet of this,
right?
Right? You know, the all of that, but sorry, I just you sparked that memory for me and talking to management teams where you're like, oh, now I've interviewed I think like 100 Internet of Things companies.
It's Internet of Things, Internet of Industrial Things. Yeah. You've got connected factories and facilities now, to where when something is going down the factory line, there's literally sensors and connectors on the assembly line taking data from the assembly line, sending it back to headquarters, 3 states away immediately, so they can analyze the production runs and the utilization and the capacity and all of that stuff. Everything's connected. Cars, everyone has heard cars are now computers on wheels. And, it's like modern day cars have 3 times the semiconductor content of cars just, 5 years ago. And then AVs are going to have, another 3 times or 4 times the content of what we have now. And so you see this proliferation of chips. I'm going to get back to electrification in a second, but another really interesting theme that I don't necessarily think gets the attention it deserves, Robert, is the diversity of demand, the diversity of use cases. So semiconductors used to be a hated industry, and now sometimes it still is a hated industry, but it used to be a hated industry because it didn't have diversity of demand. The semiconductor demand cycle used to be driven by the PC cycle, pretty much. And then it was driven by PCs and mobile phone cycle and the iPhone cycle. Other mobile phones, but the iPhone cycle. And so it expanded to just PCs and maybe some mainframes, to PCs and mobile. And that was a big expansion. Diversity of demand expanded. Use cases expanded. But then, look at today. Look at the use cases. Semiconductors are in everything. Everything. Weapon systems, medical devices, gaming systems. You use them for crypto mining. Obviously, AI data centers, GPUs, CPUs. They're in your cars. They're in your phones, they're in these smart glasses that Meta's putting out and Snap are putting out. Semiconductors are in everything. Cloud, not only AI data centers, but traditional cloud data centers are different things. They're designed differently. They have different equipment, different types of semiconductors. And so now semiconductors are less cyclical than they used to be in the past. They're also less cyclical because we had sort of 2 or 3 major consolidation phases over the last 20 or 25 years. So you have fewer players and they act more rationally when it comes to pricing. But you also have this increase in diversity of demand, increase in use cases. So yeah, it's still cyclical, but the troughs and the peaks and the troughs are less steep. You also see this with natural gas, for example. I mean, the diversity of demand there, the diversity of demand for electrification and power is expanding into data centers. They want to pump natural gas and put, really large natural gas turbines running these data centers so that they're running 100% of the time, 99.999% of the time, no downtime. Because, the power goes out, power lines fall down, whatever, you have a bad storm, wind's not always blowing, sun's not always shining, yada, yada, yada. But when you have these massive, expensive, highly complicated, highly complex gas turbines, you can basically run these things, for a really long time. And so you get this diversity of demand, not only in semiconductors, but in natural resources. In natural gas, And so it's fascinating. I don't think that's getting necessarily enough attention just yet, which it will. But back to electrification of everything. Last thing I'll say,
real quick, because I do want to get back to electrification. I'm literally titling this title of our pod "Electrification" because I find this fascinating, and you've clearly done a ton of research on it. But I want to ask why, and why the diversity of demand and use cases. Why do you think that isn't getting more coverage than you think it should be?
I don't necessarily know. So maybe it is, and it's just not the stuff that I'm reading enough of. But I read a lot. So the diversity of demand you do see on the semiconductor side. Analysts are talking about that, investors are talking about that, but not so much on the natural resource side, not so much on the natural gas side. And natural gas, and look, I don't have a pure play natural gas E&P in the portfolio. This is not. I'm not talking my book here. It's just fascinating that natural gas seems to be, in 9 out of 10 versions of the future that I can envision. Because, it's impossible to predict the future, but that's what we're trying to do as investors. We're trying to predict the future. Which stocks are going to be higher, which assets are going to be higher, which securities are going to be higher in the future. In 9 out of 10 versions of the future that I can think of, natural gas is a bridge fuel. And it's a crucial bridge. It has to be. It has to be.
No, I don't think anybody listening to this would disagree. There's been some talk of coal, as potentially also being a bridge fuel too.
Yep.
In many respects, cheap power, right?
Yep. Absolutely.
So I think all of them are on the table, and like you said, that's a great phrase. The idea of it being a bridge fuel, for folks.
A bridge fuel, yeah. And so I don't know why it's not getting enough attention, or maybe I'm just missing it. To be fair, but I do think you have this diversity of demand, this expansion of use cases, which I think is very interesting related to natural gas.
100%. All right, so back to electrification. Sorry.
So, the last thing I'll say is, that's the grid, the electrification of everything. That's what I'm most excited about from a thematic standpoint. And, Goldman Sachs has estimated that, I mentioned the grid is on average 50 to 70 years old in the US, and Goldman Sachs estimates it'll take 40 years to replace 50% of the grid, 40 years to replace half of the grid, 80 years to replace 100% of the grid. If they're off, let's say it takes 20 years to replace half the grid, that's still a long time. And it's longer than most market participants look at. Right, but Goldman is estimating it's going to take 40 years to replace half of the grid, and I stress that number because of what I opened with when we talked about the philosophy of my strategy. It's the durability of the growth. That's really what I'm looking for. Are these secular demand drivers that I think are very long duration in nature, based on my analysis. And if you look at that. We're talking about 20 or 30 year build out of the grid.
Absolutely. So taking another step further within this theme of electrification of everything, because I find it fascinating, and we quite frankly, just anecdotally in all the interviews that I do with managed, even in the microcap space over many years, a lot of these microcaps could be potential buyout targets, and or they may continue to grow organically and become small mid cap at some point. But I mean, within you mentioned the grid and probably the opportunities around that, but within the electrification of everything, again, you don't have to talk your book or specific companies or anything like that. Within that, what has stood out in terms of quality, of real quality businesses that have been able to kind of either sustain some of this outright outrageous growth and will have actual runway for the future? What are some of the criteria that you're seeing within there that folks can look at and say, okay, this is what quality kind of looks like within the electrification of everything?
I mean,
that makes sense.
Yeah, it does. It does make sense.
Okay,
It's a fantastic question. So, I mentioned this global infrastructure provider. They have $100 billion of, it's actually 119. So if you want to Google $119 billion of backlog. So when I'm analyzing that backlog, what stands out to me as quality is that the backlog in the out years is significantly higher margin than the projects they're recognizing revenue from today. And so you have not only this organic revenue growth that is driven by these mega themes that we just talked about, which is the top line growth, but you have clear margin, I think clear margin improvement opportunity from this higher margin book of business that doesn't even start to hit their books until 2026, 2027, 2028. On top of that, not only are the machines they're going to be selling higher margin, the actual equipment, but attached to those machines are long-term service contracts, which are higher margin than the machines. So the fact that in this example you have long-term organic revenue growth combined with what I think is clear margin opportunity, clear opportunity to increase margins over time. By the way, this company also gets margin improvement. They're actually a lot of companies talk about lean. This company actually is lean. It's sort of built into their culture. And so plus the efficiency gains they get from their lean culture, that operating leverage leads to much faster earnings per share growth than top line growth. And the margin improvement also drives an increase in returns on invested capital over time. And I mentioned in my opening, I'm looking for high and or rising returns on invested capital. The reason is because some of the most alpha over time in the market has come from not only businesses with high returns on invested capital, but with high returns on incremental invested capital. And so it's those companies that are inflecting from one quartile of ROIC to a higher quartile. And Mobison has written about this, as have some others. I've actually published an article on it as well. And so when you can see that inflection ROIC, not only do you get this long duration per share, earnings per share, or free cash flow per share growth I just talked about, but you also get a re-rating in the multiple. Because PE multiples are driven by three numbers. It's actually math. A PE multiple is a condensed, collapsed DCF. And PE multiples are driven by return on incremental invested capital, earnings growth, and the riskiness of the business which flows through the equation as the cost of capital. Well, if the returns on incremental invested capital are rising, you could likely, I think, see a re-rating in the multiple. And so you get that twin engine, that twin turbo engine of returns coming from both EPS growth and a higher PE multiple. That's one way I look about it. Another company is an HVAC company that I have in the portfolio. And this company makes, they sell residential units. They sell commercial units, which you would find in like a McDonald's, or Raising Cane's, sort of fast food restaurant. But then they also make what the industry calls these applied units. And these applied units are highly complicated, unique to the specific project, highly complicated, highly customized, massive, very expensive machines that go in, for example, a new $20 billion semiconductor foundry. This is a machine that is made just for a specific foundry that costs $20 billion to build, right? And if you think about a semiconductor foundry, they can't have a speck of dust, not a speck of dust in some of these rooms. And so you think about the levels of cleanliness and air quality they need. These applied systems are also going into these AI data centers because these data centers run so hot, and part of the cooling comes from HVAC. The other part comes from liquid cooling. These applied machines may go into a new 50 or 60 or 100 story skyscraper. So these are unique, customized to the project. They're very expensive. Those machines come at higher margins than a residential machine or a simple commercial machine that goes into a McDonald's, for example. But to your question on quality, not only are these applied machines higher margin, but because they are so customized, you can't just when they need repair and replacement parts, you can't just take a part off the shelf because this is a unique machine made to a unique building, unique project. And so these machines, these applied HVA machines, have services revenue that is equal to 8 to 10 times the cost of the initial machine. 8 to 10 times the cost of the initial machine, and that services revenue is also much higher margin. So that's another example of where you can get both organic top line revenue growth and margin expansion over a long period of time, which drives the operating leverage, drives the high, I don't want to use the word high, drives the attractive, sort of mid-teens per share growth over an extended period of time. Does that answer your question about quality?
That very much does. I think you broke it down pretty good right there. So, another question that I ask everybody on here, well, you know what? I also want to get into your research process. Let's say you narrowed it down to a few names that hit a particular theme that you're looking at. How do you then? What's your next steps from a qualitative perspective? You mentioned how important it is, how important management is to you. Love to hear your thoughts on getting access to management, because look, we're in microcap land. You're fun. You're interested in talking to management. It's pretty easy, right, for the most part. So love to hear your thoughts there.
So I'm going to go through the process, but I'll say one thing that I do like about I'm going to say small caps because I've never really invested in micro caps. One thing that I do like is, two things that I love is the businesses tend to be easier to understand and the 10Ks tend to be shorter because a lot of times they just have one line of business, right? It's not like a global conglomerate or a holding company that has, 6 or a dozen different lines of businesses, and the 10Ks run 300 pages and the footnotes run another 100 pages. And so one thing I really like about small caps is a lot of times the businesses are easier to understand. And the other thing is you can get the management on the phone. Sometimes the CEO answers the calls, like literally answers the phone when I call, or directly answers the emails that I send, come from the CEO or the CFO. A lot of times they don't have, dedicated person that's head of IR. A lot of times the CFO is the head of IR. And so it is, and these companies are undercovered by Wall Street. But a lot of times they're great companies and they want to tell their story. And so they're willing to talk to you. Those are two things I really like about small caps. My process is for a new idea, right? So I tend to kick out 90% of new ideas within an hour. I have 30-ish stocks in the portfolio that I run, and another 30, let's say, could be 40, but let's say 30, that I have researched well, I believe. I've researched thoroughly, and I'm ready to buy when the market gives me the opportunity. So that's 60 stocks. 30 in the portfolio, 30 high on the watch list. Most of these, most of my time is spent on staying up to date and maintaining coverage on those 60 names. I think that's how I'm going to add most value to my clients. When it's not earnings season or when I find some free time, I look for new ideas, and that's always fun and it's very enjoyable. But I say no to most of those ideas in an hour. I just kick them out because I have a fill or kill process that, in less than an hour, I'll quickly. So first thing I do for this 1 hour is I go to the proxy. It's the first thing I do because I mentioned how important management is to me. And I just do some word searches to see things that I'm looking for, how they're incentivized, what are the stock ownership guidelines, what are the, a lot of proxies have what we do, what we don't do. Do you have a clawback? Do you have a golden parachute? Is the CEO separate from the chairman? Or do you have annual election of directors, or are they spaced out over 2 or 3 years? Do you have majority voting? Are there a lot of extra perquisites that the senior managers are getting that the rank and file employees are not getting? Ownership, how much do insiders own? Variety of things. And these are just word searches. Later on I'll read the proxy very closely. So I just glance at the proxy, right? And then I glance at the balance sheet. If I'm not comfortable with the balance sheet, it's gone immediately. After I glance at the balance sheet, I glance at the financial statements. Going back 10 years, let's say. Is the company growing? Does the company have stable or rising margins, stable or rising returns on invested capital? Do I just by looking at the numbers, do I see any cyclicality in the business? Do I see any operating leverage in the business? What are the historical rates of per share growth and of top line growth? Does the business, you don't have to talk to management to understand capital allocation. Literally every line of capital allocation is a line item on the cash flow statement. It's a line item. From free cash flow, depending on how you calculate it and whether you include acquisitions or not, all you can do with free cash, let's say you don't include acquisitions, all you can do with free cash flow, by definition, is make an acquisition, pay down debt, pay a dividend, or buy back stock. That's it. You have 4 choices. Each one of those is a literal line item on the cash flow statement. Acquisitions, line item. Debt pay down, line item. Repurchase, line item. Dividends, line item. So you can easily see what are the capital allocation priorities. Is the company devoting more to the dividend every year or buybacks? Does it have a lot of debt? Does it have to constantly pay down debt? You can also see if the company is opportunistic with its buybacks right off the cash flow statement. Does it buy a little bit and then all of a sudden buybacks shoot up in 1 year? And then you go to Yahoo Finance or something and look if the stock price was weak in that year. Were they buying into weakness, which is high on my watch list? I want companies that are buying back stock cheaply. This is all, and then if there's a slide deck, an investor day presentation or something like that, I'll go through that. Maybe read if there's an CEO letter, and if there's not a CEO letter, maybe I'll scan the 10K or read the most recent earnings call or the most recent year-end earnings call. All in an hour, scanning, and I either kick it out 90% of the time or I decide I want to do more research. If I decide I want to do more research, then the first thing I do, well, let me say this. This is almost going to sound blasphemous to some people, and especially because I believe that I do really deep and rigorous research. I think I can get through 15 to 20% of the research process in 2 or 3 days. A day to 1 to 3 days. 1 to 3 days. Not all of it, but like 15 to 20% of the research. And what those first 1 to 3 days look like, once I've agreed that I want to research a company more, is I read the proxy. First thing I do. Now I'm reading every word of the proxy. Second thing, I read 10K. Every word. If there's a CEO letter, I read that. If there are several CEO letters going back, several years, I read all of those. This is all part of this first 1 to 3 days. I read the most recent earnings call thoroughly, and I read the most recent year-end earnings call thoroughly. I mentioned the 10K. I then do more deeper, more thorough financial statement analysis, earnings quality analysis, financial statement analysis. Want to make sure I understand how the business makes money, how sales flow down the income statement to net income, how net income then flows down the cash flow statement to get free cash flow. I want to understand the business. And that's basically the first, and if I have any, and I do, I have access to some really good sell-side research. I'll read some sell-side research in those first 1 to 3 days. I'll look at consensus estimates just to see what the market's pricing in. Just to see. I haven't come up with my own estimates yet. This is all in the first 1 to 3 days. After that, the rest of that week is I spend a lot of time on earnings calls. I find earnings calls to be some of the most valuable material for me in the way that I do things. Also in those 1 to 3 days, sorry. If there's an investor day, I go through that more thoroughly, read the investor day transcript, and go through the slide deck more thoroughly. So, that's 3 days. So now there's another 3 or 4 days in the week. Earnings transcripts. I'll go back 2 years. I'll read another 8 transcripts. I spent a lot of time on earnings transcripts. So that's a week. The second week, I try to really dive into the industry. So now I've gotten a really good feel for this one company. Then I try to understand the industry and the 2 or 3 other, main players in the industry. So I repeat a lot, not all, but a lot of what I did for that one company with the sort of 2 or 3 other key players in the industry. Sometimes during this second week, during this process, I end up liking one of the peers more than the first company that I spent the first week on. So I'm really diving into the industry, not only by studying the other companies, but reading industry journals if I can get my hands on those. I found an industrial gas company that I've done other podcasts on by reading Gas World. That's just one example of where a journal really helped me out. Industry journals, third-party industry resources like a Gartner, if they have any metrics for how large the industry is, who are the leading players in the industry, how fast they expect the industry to grow, and Gartner, Forrester, eMarketer, there's different ones. I try to get my hands on that. I read more sell-side research, especially longer form initiation reports and sort of industry deep dive reports. That's the second week. And then the third week, I'm trying to speak to management as long as it's not a quiet period, as long as I can get them on the phone. I'm pretty good at getting management teams on the phone. I may not be able to speak to a C-level exec, but I'm pretty good. I'm on the phone or email or something. I'm pretty good at getting IR to get back to me because I just don't relent. I just don't give up, honestly. And they, at some point, just give in. I don't stop sending emails until they get back to me, honestly. And so I'm pretty good at getting them to speak to me. And then honestly, I built long-term relationships with a lot of these heads of IR that I'm very appreciative of. The third week is trying to speak to management, doing some valuation work, some modeling, and maybe most importantly is bouncing this idea off of other investors in my network, people that I respect, people that I know are going to give it to me straight, and try to really bust holes in that thesis. One last thing I'll say. From the first second that I start this process, from the initial first hour, from that first killer fill, I'm writing down questions that I have about this business. And as I go through this process, I'm writing down more and more questions. And as I go through this process, I'm answering a lot of those questions myself as I learn more about the business, as I dive deeper, as I read more and talk to more people about it. The questions that are remaining at the end, the ones that I have not really comfortably answered on my own with conviction, those are the questions I ask management when I finally have a call with them. And I would say, on average, 3 weeks is how long it takes me to research a business long enough to build conviction in what I want to do going forward. Either, buy it or continue to monitor it very closely on the watch list.
Very good. That is extremely thorough, John.
Can I say one more thing?
Yeah, Robert, go for it.
Sorry.
Yeah, go.
Thank you for the kind words. I appreciate it. The expert calls. So these are very helpful. And, you know, when I was at the Motley Fool had chat rooms, these boardrooms, and a lot of them were public. And it was almost like we had our own expert call network. It wasn't, and that's not what we called it, but we had these chat rooms. And so you could go in these chat rooms, and let's say, hypothetically, I'm, you know, researching a medical device company. Well, you can go in these chat rooms and find a surgeon that, because, you know, the Motley Fool had a lot of followers and subscribers. And you can find a surgeon that's actually using the medical device in their operations. Or let's say I'm, you know, in researching and investigating the home building industry. Well, you can go on these chat rooms and find home builders, not just home builders building one house a year, but, you know, small, kind of local, even regional home builders building 10, 20 homes a year, using these building products and supply companies that I'm researching, you know, that are very familiar with the demand environment and the supply environment. And so I was using expert call networks in a sense through these chat rooms before they were even really popular. And I found out how valuable they could be. And now, you know, AlphaSense has a great expert call network, and I've used AlphaSense in the past. They acquired Tegas, and it's a great resource. It's truly great. I don't have access to AlphaSense right now. But I do have access to a lot of good, leading, high-quality sell-side research. And the sell-side firms are starting to do more of these expert calls. And, you know, Bernstein, for example, just did an expert call with the former head of Google's data center infrastructure business. Not Google Cloud, but the person that's responsible for actually building out those data centers, picking the sites, negotiating the contracts, building out the supply chain, and, you know, buying all the equipment for the data center, monitoring the construction phase of it, understanding the power requirements and where they're going to source that power from. And so a lot of the sell side firms are doing these expert calls now. Goldman Sachs just did one with a sort of similar person for Microsoft, their former head of data center build out. And so I'm finding these calls very helpful as well. And that usually falls into that second or third week of the process for me.
Very good. So I want to ask a question I ask everybody on here, and we're running up a little bit on time, so I want to kind of get this in before we jump off here. What would you say has been an investing experience that really changed your career, your trajectory? Just, I kind of leave it open-ended, you know, one that affected you in the positive way, maybe changed up your philosophy, changed up your strategy, you know, one that you just always go back to, whether it was a win or a loss or negligible. It could have been a minor win, minor loss, but that you really just took a lot of lessons learned from, and maybe also, yeah, just took a lot of lessons learned from. You can name the name if you want. It's up to you.
Yeah, I'll give you three quick ones. And one is a name. So the first one is writing a book. So I published a book on investing in 2013. I wrote it in 2012. Publishing a book is hard. It took a year.
Heck yeah, it is.
Yeah, it took a year of work. And the book wasn't great in the sense that I've become a much more experienced investor, a better investor, and a better writer since then. This is over a decade ago. You know, 12 years ago, I wrote the book.
I mean, you don't have your ascot yet, so, you know.
Right.
So I'm just, okay.
But, you know, writing that book got me, I believe, my job at the Motley Fool. Because it distinguished me, it helped me stand out. It showed that I understood investing and that investing was my passion. So the lesson was, do hard things. Do hard things well. Do things that distinguish yourself. And people will notice. That's number one. Number two is the podcast. under the same sort of theme of do things that distinguish yourself. I think the podcast changed my life more than anything because it's how my new boss and firm found me and identified me. And this is truly the dream job because not only do I get to manage, not only do I get to be a fiduciary, which means I put my clients' interests before my own, which is how I would do it anyway. Not only are they giving me the opportunity to be a fiduciary, but they're giving me the opportunity to manage a fund in the way that I think is best for my clients. I got to pick the strategy. I got to pick this. I'm the sole portfolio manager. I got to pick the stocks. It was my idea to put together a Q&A that we published, some collateral that we published. They have taken all administrative work off. I have no administrative work. They don't want me to have any administrative work. That was part of the deal for me to come over. Cassel said, John, we just want you to focus on research, on your portfolio, on managing the portfolio, on mitigating risk, and doing well for your clients over time. So I don't have any of the back office, middle office administrative duties. All I'm doing is reading about these businesses, managing this portfolio, and talking to my clients. And so in that sense, it's a dream job. That's number two. Do things that distinguish you and get you noticed. The third is, I think the stock that has had the biggest impact on me is probably the one where I've lost the most money. Not the most money, but it was my biggest loser percentage-wise, and I no longer own it, and it's not in the portfolio that I manage at Islamorada. The stock was Peloton. And I finally sold out when I was down like 80%. And my thesis was that, it was a bad thesis, but my thesis was that it met a lot of the pattern recognition that I noticed at successful investments I had made. And I'll mention those. I still own them personally. They're not in the portfolio that I manage. They were Apple and Tesla. And those were very successful investments for me. And what I noticed in Apple and Tesla is they were rare companies that excelled at both hardware and software and building out an ecosystem. And they both had rabid fan bases. Rabid. I mean, if you think of people waiting in lines for things or going on social media and raving about the product, you think about Apple and Tesla for the most part. And so rare company that excelled at hardware and software, they built an ecosystem and they had this really strong community and following. I saw all of those things in Peloton. Now I must have been, looking through beer goggles or something, but, they made hardware. They had the software component. They did, almost Hollywood caliber production of the videos, these workout videos in terms of the sound, the lighting, the quality of the instructors, the physical appearance of the instructors. They had an unmatched music catalog almost. They got into some trouble with that for a while, but and they had a rabid community of followers. There were literally people getting Peloton logo tattooed on their body. There were Peloton groups on Facebook. My sister was part of a Peloton, women's club down here in New Orleans. All they talked about was Peloton. All they, obviously they had families and they, took care of their kids and everything, but it was their key pastime and passion. Peloton came out with a clothing line. And so there was this rabid community following. And it was awful. And it was awful, not because I lost money. That doesn't bother me personally, but because I went on Motley Fool Live, this video cast that we had at the Motley Fool, and I expressed conviction in it. And I told people that I doubled down in it at one point, which was all true. And I assume some Motley Fool followers also bought the stock. And that was excruciatingly painful for me. Because it was a massive loser. I assume people followed me in, and I have not really forgiven myself for doing such poor analysis on Peloton and talking about it publicly.
For sure. No, hey, look, you know what? That's one of the things that, you risk in talking about some names publicly. And look, that was a big enough name where you weren't the only one
Yeah.
that, so I mean, I'm not going to sit here and like, don't beat yourself up, but
Thank you.
but I mean, that's
it's one that sticks with me, and it's one that I've hopefully learned a lot of lessons from and have tightened up the process and the checklist a little since then.
absolutely. No, listen, you were saying that all while I was looking over to my left, my Peloton bike.
There you go.
Right there. Not a shareholder, but yeah, I got the bike. Well, John, this was great, dude. We covered so much here today, and my goodness, I really hope anybody listening in that you're able to glean some incredible stuff here. So, John, with that, where can our audience go and follow you on the socials and also the Islamorada website?
Thank you, Robert. Thank you, listeners. I really appreciate it. I'm on X at JROGROW. So that's at JROGROW. And then our website is just islainvest.com. ISLA
Beautiful. Well, John, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. I look forward to our next update and see you in Vegas, maybe.
I hope I can make it. Sounds like an incredible conference that y'all are throwing. And thank you again. I really appreciate the time and the great questions and the great conversation.
Absolutely.